Leroy Senior, and I'm the creator of the Smart Money Manuscript. But Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your roadmap to financial freedom. Inside this powerful course designed to transform your financial future, I've meticulously condensed over 1,000 of my public YouTube videos into 40 highly efficient lessons that span just 2.5 hours. This course is strategically designed into 4 phases to help guide your learning in the most logical and effective way possible. Phase 1 lays the groundwork, covering essential financial literacy like budgeting, banking, and taxes. In phase 2, you'll move beyond the basics, learning about brokerage accounts, figuring out how much you need for your own individual retirement. You learn about how to do fundamental research on companies, and you'll also learn how to conduct technical analysis by looking at stock charts. Phase 3 empowers you to build a robust portfolio and leverage your capital using advanced techniques like options and futures, and it also teaches you the importance of backtesting your strategies. Finally, phase 4 takes a deep dive into the advanced ICT concepts, giving you a professional edge. Each lesson includes a short quiz to help solidify your understanding. By the end of this journey, you'll have the confidence and tool that you need to make intelligent investing decisions, manage your money without fear or ambiguity. So if you want to be a long-term buy and hold investor, if you want to be a swing trader, if you want to be a day trader, if you want to trade stocks, if you want to trade options, if you want to trade futures, the Smart Money Manuscript is for you for $69.99. Yes, $69.99 for all of this here. What's going on, everybody? Hopefully y'all make sure I close all of this over here. I'm tweaking. I'm tweaking. Well, I still got this up. Sharing over here. Make sure I ain't sharing none of this. I got all my. I was up here taking care of some importante stuff.
Tim, you talking to us?
Y'all can't hear me?
Yeah, I can't hear him on my computer either. But
No, I
I
can't
can hear him
hear
on
him.
YouTube.
Oh, I can't hear him on Zoom.
Yeah, I can't hear him on the Zoom either.
Hold on, man.
Okay.
This doggone Windows 11.
Oh, there you go.
On.
Well, I just heard he came in for 1 second.
There you go. All right.
There you go. Yeah, it's there.
All right, man. I'm like, this doggone Windows 11, boy, look at here. I'm constantly having to redo my audio and all kind of stuff like that, man.
Oh, you say everybody else got cheap stuff. You might have cheap equipment, homie. Where you shopping at?
No, ain't nothing cheap about this, huh? Ain't nothing cheap about this. All I know is Windows. Ever since Windows 11, it's been doing this. Ever since Windows 11, it's been doing this. I got to constantly change, but ain't nothing cheap over here, homeboy. Believe that. Believe that. Now, you already done seen it.
Swap meet computers, man.
You already seen it.
You still shopping at Radio Shack, man? That's a Tandy.
Yes, it is. It's top of the line Tandy. You feel me? You know what I'm saying? Now you gonna make me break my hoof off in your little goose.
Hey, you know I never sat down and watched Norman. I say, man, I'm going to watch this fella's favorite movie.
Norman, a classic, boy. I love it. Lord Norman, boy.
Norman lost it right there. He doing that puppet show. That was
Norman he drove Rasputin's car. Rasputin got in there. Rasputin said, I know you move my seat because every time I breathe, my titties make the horn blow. That's science. He said, that's scientifically proved that you. Norman said, that's not science. I said, it's science. Well, Norman, hey, I love Norman, man. I love Norman. As a matter of fact, I got to go find it so I can look at it tonight. Go to youtube.com the new TLR so you can see the screen. We getting into another lecture for tonight for Facilitation February. We're going into another lecture. So go to youtube.com/the new TLR so you can see the screen and you can join inside the lecture for tonight. Tell a friend to tap in. Good evening, everybody. If this is your first time tuning in to Tim's Tidbits, and if you can hear me now, I like to say welcome. If it's not the first time tuning in to Tim's Tidbits, I still want to say welcome, but I want to give you a nice hearty thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That just means big spot if you don't hablo Espanol. And you're in tune to another episode of Facilitation February. What facilitate? Give yourself a round of applause for tuning in to Facilitation February. Thank you. Thanks for tapping in. I appreciate you. I appreciate you for tapping in. What Facilitation February is, we are going through Flicks on Me. What's up, Tim? Long time. They gone now. But anyway, what Facilitation February is, we are going through, while I'm talking about going through, let me get the lesson together. We are going through The Art of Reading Price Section playlist, and we're going through video by video. We've been doing this for the entire month of February, and we are not only looking at the video, but I'm doing a deeper dive into the concepts where Michael has given us more detail, or I have a better understanding of it since I made this playlist over a year ago, or if it's something new that Michael has taught us when it comes to the concepts. At the end of the video, I will be opening up the floor for the gang. Those that are watching via Zoom, if anybody has questions. If you're on YouTube, feel free to talk amongst yourselves in the chat. I will not be monitoring the YouTube chat for questions. I will only be taking questions from the gang inside Zoom. I'm not looking at the Zoom chat. I'm not looking at the YouTube chat. If you got a question, at the end, unmute and say, hey, Tim, I have a question. All right. Tonight, we're going to be looking at order flow. Got 2 videos to watch tonight. Looking at order flow part 1 and part 2. And then starting tomorrow, Monday, we're going to start tape reading. Right. I wanted to be done with the series. Right. We got order flow, market maker models, and power of 3. Right. I wanted to be done with the series before we started tape reading, but that's not going to happen. We'll be done with the series Monday evening. But Monday, Wednesday, and Friday next week, we are going to be tape reading from 9 a.m. to 10 a.m. Monday, Wednesday, and Friday. And then next week on Tuesday and Thursday, we're going to be tape reading from 7 p.m. to 8 p.m. Right? So give everybody an opportunity to get a chance to sit down and look at the charts in real time and study and look for the signatures in real time. If you can do it in the morning, or if you can't and you can only do it in the evening, or if you just want to do it during both times. Okay. So that's starting tomorrow. Tonight we're going to do order flow. Tomorrow night at 8, we're going to do the market maker models. There's 3 videos to watch for the market maker models. And then Wednesday night, we're doing the power of 3. All right. We're going to do the power of 3 on Wednesday night. And then that'll be the end of the series. And then we'll finish out the week Thursday night and then Friday morning with the last 2 days of tape reading. Right now, before we get into it, who we got in here from the gang? Who we got in here? Gang. I see. I got it set on a different view so I can only see me. All right, I see Steve up in here. What's going on, Steve? I see Marco up in here. I see Yolanda up in here. I see Jim up in here. Deborah. We got Valentine up in here. We got Lump up in here. Miss V. See Joe up in here. All right. Shout out to the gang. Shout out to everybody that's on YouTube too. If you tuned into YouTube, hey, do me a favor, hit a like for the algorithm. And if you're not subscribed to the channel, you know what to do. You feel me? Yeah. Without further ado, I hit it's airing the wrong screen. So let's go over here. Share screen 1. There you go. I got 100 things open. Turn your attention to this screen over here. All right. Turn your attention to that screen over there. And we are going to get into order flow, part 1. Says it's a 17-minute video and a 14-minute video. About to be a long one tonight. Greetings, salutations, salutations, however you say it in your neck of the woods. I'd like to welcome you to another episode of Le Art of Again, welcome to another episode of the Art of Reading Price Action. And in this episode of Le Art of Reading Price Action, we will be discussing the order flow. Yes, the infamous institutional order flow. Before we get started, I'd like to introduce myself for those who may not know who I am. My name is Timothy Lee. Reading Price Action, the order flow. Put your attention over there. Not on me, put it over there, right over there, where the little bouncing ball is over here. Put your attention right over there. Now, let order flow. When it comes to institutional order flow, all right, the algorithm is seeking the institutional liquidity, and this liquidity can easily be found on the monthly and the weekly time frame charts. If you study the monthly and the weekly time frame charts, you would learn to see where the large fund liquidity is resting, because the algorithm tips its hand at what it's doing. And with all the other teachings you've learned thus far, you understand the different ways the algorithm tips its hands. Remember, stacks on stacks on stacks on stacks, blocks on blocks on blocks on blocks, right? But the major shifts, they like jump out at you. They jump out at you on the higher time frames in hindsight. So what you want to do, you want to go back and look at the charts, right, in hindsight, and let the obvious price moves just jump out at you, right? And then you'll start to train your brain and train your eye to think in terms of the market efficiency paradigm. Remember the whole thing where everybody in the big circle, everybody in that big circle over there, they are the liquidity for everybody in that little circle over there, right? You start to think like the algorithm, right? And when you start to think like the algorithm, you look at the chart and you say, where is the maximum amount of liquidity? Where is the imbalance, right? Where is the inefficient, not just the imbalance, where is the inefficiency in price? You start to train your mind to think like the algorithm, think in terms of the market efficiency paradigm. And when you're looking at the monthly chart, starting at the month, any chart really, but starting at the monthly chart, then you start to focus in and see the areas of maximum liquidity and inefficiencies. You start to see it, right? What you want to do, you want to start by just looking at what price has done. Follow the order flow. You see price consolidated here, and then price sold down, right? Price went back up into that range. Price sold down. Price went back up into that range. Price sold down. Price went back up. So what is the algorithm doing? The algorithm is coming down to a type of external liquidity from this range, from that low to that high. Right? Price come down to external liquidity, move back into the range to internal liquidity, comes back down to external liquidity, moves back into the range, internal, external, and it's moving to the maximum amount of liquidity and inefficiencies. It's seeking liquidity and balance. Right? Now, on the higher time frames, we're talking about the monthly and the weekly. The bulk of the volume is in the bodies. You always hear the saying, bodies tell the story, wicks do the damage. Right? So as price is moving on the monthly time frame, okay, when price is up here, if price wants to go higher, okay, the bulk of the liquidity would be above these bodies here. Okay, but price has come up and taken out buy side over here already, and it's left a buy side inefficiency from this low to that high. Right? It's only offered buy side. So when the algorithm gets here, right, it has come up and taken buy side liquidity. So it has already found liquidity. Now it's going to seek balance. Where's the inefficiency? Where's the imbalance? We have a buy side imbalance here. So price comes back down and fills in, offering sell side delivery, filling in the buy side imbalance. Now, when it gets down here, okay, it's filling in the imbalance. Where's the liquidity? Right? On the higher, the liquidity is over here. But on the high, yes, we did get below the wicks here, but on the higher time frames, the bodies tell the story and the wicks do the damage. So realistically, all the algorithm has to do is get below the bodies of these candles, because the bulk of the volume for this move up here is below these bodies. So, and if you look at these bodies on these candles over here, they're respecting the bodies of these candles, because the bodies tell the story and the wicks do the damage. Now that we've reached the liquidity over here, where's the imbalance? We have a sell side imbalance coming down here. So price moves back up, right? And it eventually gets all the way back up to where? The SIBI all the way at the top, but it also gets into the wick of this bearish order block on the monthly time frame, right? What's the order block's job? To block price. So price traded back to a monthly order block, right? Stopped at the order block after trading back up into the inefficiency. I'm gonna pause it right there real quick and we're gonna touch on this. If you notice, right, remember that day we was studying order blocks, what did we say? You're looking, the order block is on the side of price where we was making the move up or down. In this case, it's up. So when we're moving up, right, yes, we do have a bearish order block here that's resting inside of this order block, but since it's inside of this and this is an up close candle after we've made the peak and starting to retrace slash consolidate, this is your order block here. Matter of fact, all of these candles here, from this candle all the way up there, that's your order block. But we put the focus on the last up close candle. And what does price come? Price come back to the wick of that right there. And remember, we was talking about how the fair value gap can give you a clue as to how to mark your other PD arrays. Notice the wick of this order block resides inside of this fair value gap, pretty close to consequent encroachment, looks like, But where's its hypersensitive at? Right there inside the wick of that order block right there. Right? Inside the wick of that order block. And plus, not only is that inside the wick of that order block and inside that fair value gap, what is that right there? What imbalance is that after we leave this little area right there? That's the first imbalance with displacement outside of this area right here. Right? So when we come back down, what is that? That's our, you got it, inversion fair value gap. This stuff even works on the monthly time frames. Carry on. And then it trades back down to where? The maximum liquidity. Where's the maximum amount of liquidity? Below these candles here. Yes, below the lows, right? All retail traders will have their lows below these wicks. Why? Because this is now support. Okay? But on the institutional level, all it needs to do is poke below the bodies of these candles. Right? And then if we look here, where did it stop? If we look to the left, everything you want to know is always to the left. Move over here. It stopped where? At a bullish order block. Right over here, you have a bullish order block coupled with a propulsion block. That's a type of order block. You got your consolidation. Move away. The order block is found right at or near equilibrium of the consolidation. So you have an order block that's bouncing off of another order block. That's your propulsion block right there. Boom. Right back into the bullish order block, propulsion block, and then move where? Back into the range of the inefficiency. How do you train your eye to see this? Well, one thing you can do, got this straight from Michael's slides, all this straight from Michael's slides, is you go through and you mark out the bearish and bullish order flow on the monthly level. Squeeze the chart up. You're using hindsight to your benefit, right? Squeeze the chart up and highlight clear bearish moves, clear bullish moves when price is moving from external to internal liquidity. When it's clear that it's moving. Remember I told you this, the clear shifts would jump out at you. When they jump out at you. Mark out those areas, right? In this case, Michael marked out the bearish in red and the bullish times in blue. And then once you mark those out, mark out any important PD arrays on the monthly time frame, right? Price came down. It up here, it traded back up into a bearish order block. Okay. Again, we got a bearish order block over here. Yes, it overshot it a little bit, but you got a bearish order block over there. So you're marking out any important PD arrays that you see on the monthly chart. Okay. And remember, take note of how price trades below the bodies or above the bodies of the candles when it's seeking liquidity, right? Bodies tell the story, wicks do the damage. And you can also study when it wicked below, where did it actually go? Where did it stop when we wick below? Where are these wicks really going? Move down to a weekly time frame. Now that you've got the whole monthly order flow, the monthly order flow marked out, now you can go back and study how did price move during that time, right? During this time, I was bearish because the monthly order flow was bearish. So I was looking on the weekly chart for opportunities to sell. I was looking for opportunities to sell on the weekly chart because I was bearish. And you go in and you annotate any important PD arrays in the blue. Don't forget about the buying. I was looking for opportunities to buy on the weekly time frame because the monthly order flow had told me it was time to buy. Now, keep in mind, when you're on the lower time frame and you're waiting for the lower time frame to align with the higher time frame, the key indication is taking out a key, high, or low. In this case here, as price drop down, you know, on the monthly time frame, this area down here is when price had dropped below the bodies of these monthly candles in this area here. So when we got this shift above this short-term high right here, that was an indication that price was ready to go back up, and you could be looking to buy in that area now. If you are more advanced, you can take advantage of shorting during a bullish time frame, but you always want to try to trade on the side of the institutional order flow. Okay, and it's simple as that. Same thing. You go down to the daily time frame, and if you're in a monthly bearish order flow, you look for opportunities to sell. If you're in a monthly bullish order flow, you look for opportunities to buy. And again, remember, taking note of the higher time frame PD arrays, because even if you don't have a key PD array on, let's say, the daily here, like there is a daily PD array here to trade off of when price comes back, you notice it has a confluence with a higher time frame PD array in the same place, which strengthens that buying opportunity for you there. So, institutional order flow, this is just a brief introduction to it. This is just getting your eyes used to seeing price move. Okay, getting your eyes used to seeing the price move. Now, for your homework, let's go back through price. Y'all see the homework? Pause there real quick, and I just want to point something out. Back it up just a little bit. Just want to point something out. When you're studying price, okay, the lower you go down in price, you'll start to see more detail. But notice, right? If we go to the monthly time frame, we see price moves down, right? And even on this monthly time frame, we come back up here and we move back up into a premium before coming down. Then we go up, and then over here we go down. Then over here we go up, and even over here we do come back into a discount before going up. So on this monthly time frame, right, if you were looking for opportunities to sell just based off the monthly chart, when price dropped down, right, as we came back up here into the premium, you would be looking for reasons to sell. All right, over here when price comes down and goes back up, right, there's another opportunity to sell in the premium. On this move up right here on this time frame, there's really nothing to buy off of unless you buy off of order blocks, and you buy when we come back in and trade into that order block right there, right? When we come back down there, if that gives you an opportunity to buy in a discount, right, you can buy off that order block to go up, right? Because you're always looking for reasons to buy in a discount and sell in a premium. Okay, but when we start to move down in time frames, right, what you want to notice as you're studying price, you want to see the ebbs and flows of price, because like on this drop here, as price was coming down, right, you see as we displaced away here, we got like the breakaway gaps we never traded back to, right? When price pauses here, trades back down, what do? We retrace back up, right? It's given an opportunity to come back up to some type of premium, right? We're trading up above the order block, but we're still respecting it, but we're retracing back up to some type of premium on this time frame from this high to that low, right? It's an extreme premium, right? But, and then we take off again, that's a short opportunity to come down, right? But once we come down, there's no more retracements to a premium, right? When we come over here, we trade back up to a premium again into the rejection block right there, right? But it don't really give a clean opportunity to trade back down on this time frame here, right? But it just goes back to a premium. If you trade based off of rejection blocks. If you trade based off of this fair value gap there, right, you would have been safe with the mandatory stop there, trading off of that fair value gap. But that would have been an opportunity to come back down, even though it didn't deliver to the sell side. But then when you look at the bullish, right, we go up, trade back down, got an opportunity to get long here in a discount, right? If you're watching here, once we clear this area, you look, you say, okay, we've come up, right? We got a balanced price range down here. We expand away from the balanced price range. We got another opportunity to buy off of a discount of this price range there, right, to go up, okay? And up here, we're getting a little long in the tooth. Me personally, I wouldn't be trying to get long based off of this range anymore, but it does come back down to a discount of this range right there after leaving this balanced price range. That's a little long in the tooth for me. I don't know if I would be trying to get long this high in the move, but when you look at this area over there, right, this same area here, when we come over here, when we get this displacement away with the fair value gap leaving this area, we got a breakaway gap, we got the fair value gap, price trades back up into that fair value gap, giving an opportunity to get short, right? And what is that? You got this, we're breaking out of this range, right? So we're looking at all of this as a balanced price range, right? So we're coming back to a premium, right, of the area when we leave this balanced price range, right? And then we drop there, going to a little consolidation there, right? And this right here, roughly around, this is around fair value, give you opportunity to trade back up into a premium of this small range here around fair value of the entire range, right? Give you opportunity to get short also, right? But you always looking for opportunities to buy in a discount or sell in a premium, right? You always want to be buying in a discount or selling in a premium. You don't want to just you don't want to be trying to buy in a premium just because you're bullish. You don't want to be trying to sell in the discount just because you're bearish. All right, let's go into the next one. Before we go to the next one, do we have any questions from the gang?
We didn't get a picture of that homework.
You said you didn't get a picture of the homework. Man, that homework was up there for a good 45 seconds before I...
No, you left for like 2
annotate,
seconds.
keep, and then you can use the NQ, ES, whatever you want to use. This back when I was still trading the ES, so that's why I got the ES continuous contract. But whatever you want to use, ES, the NQ, if you just trade stocks, whatever you want to trade, price is price.
Hey, Tim?
Yeah.
Is there any rule of thumb for when price might return to a balanced price range?
No. There's no such thing as a rule of thumb for anything in the ICT concepts.
Okay, just watch the charts. I got you.
Yeah. Rule of thumb is just wishful thinking, right? That is like don't nobody know when it's gonna be a low resistance or high resistance liquidity run, because there's always that X factor of that manual intervention. Because we've seen many days where price be moving so fluid and we like, oh yeah, this is going to be a nice low resistance day, and then all of a sudden we just hit a rough patch and go into like extreme high resistance, and vice versa. It'd be extreme high resistance, then all of a sudden it take off and be beautiful low resistance liquidity runs. All right. So that's the reason why it's always important to take partials. That's why it's always important to, not get too greedy. It's very important to size appropriately, because you never know when that manual intervention gonna come in, as Michael like to call him, Phil. You never know when Phil gonna hit that button. So the only thing I suggest anybody take as a rule of thumb is the actual signatures. If price does this, then it should do that. We know if price manipulates liquidity and then gives you a breaking structure, right, then based off of institutional sponsorship, it should start respecting these PD arrays that is leaving behind, right? If it don't respect the PD arrays that it's leaving behind after manipulating liquidity, then we're still in that manipulation, and we probably gonna get a wig snatcher instead of a Judas swing. You know what I'm saying? So it's like you never know when, and you already know when to look for certain things. If you're bearish, if you're bullish and you're in a discount and price attacks sell side liquidity, right? Then you like, oh, I'm anticipating this to be a Judas swing, right? But if you're bullish and you're in a discount and it attacks buy side liquidity, and you're at like an anticipatory reactionary point, you want to look back and say, okay, has the manipulation already happened? Have we got the Judas swing already? Right? Because you always want to understand what's the draw. When you understand what the draw is first, now you're less likely to get tripped up in fake outs, because if you understand we in a buy program, you understand the draw is buy side liquidity. So when you see it manipulating buy side liquidity and you're already in a discount and it's a buy program, then you can say, oh, let me see if we already got the manipulation of sell side, right? So that way you're not guessing, you're going based off what the algorithm has given you, because it's not going to do everything you wanted to do when you start watching the charts. It don't care nothing about what time you start looking. It don't care nothing about what time we say the market closed. All it know is this the last thing I did, and this what I'm about to do, and let's press this button. You know what I'm saying? That's why we always want to be cognizant of what price has done to the left.
Yeah.
All right. We got anything else before we move on to part 2?
I'm good.
All right. Part 2 coming up. Greetings, salutations, Zavo. However you said in your neck of the woods, I'd like to welcome you to another episode. And you know what it come with. If you don't know what it come with, look at another episode. Order flow, part 2. Order flow. We're going to touch on buy programs and sell programs in this. In its simplest form, buy programs is when price is bullish. Sell programs is when price is bearish. But they are key indicators, key signatures, should I say, that you want to look for when you're trading the ICT concepts when it comes to buy programs and sell programs. Buy programs. In a buy program, IPTA will perform one of 2 price engine models, right? We always look for signatures. Remember I told you, look for signatures, right? And a buy program is gonna perform one of 2 price engine models. That's the offset accumulation and the reaccumulation. I know it sounds super fancy, but we're gonna read what it is, and then I'm gonna tell you what it is in simple terms, okay? Accumulate sell side liquidity by repricing under an old low. Sell stops will be triggered, inducing counterparty sellers to pair long entries with. Right? Price will seek a higher short-term premium array to offset positions. Reaccumulate fair value in retracements lower at discount arrays. Weak long holders will be squeezed in this retrace lower, right? Price will seek to expand higher to a short-term premium array to offset positions. Whoo, that's a whole mouthful. You're probably looking like, what did Tim just read? Let's continue. Okay, offset accumulation. IPTA will reprice the market below an old low to promote sell stops that would be residing there for current long holders. This is in essence engineering sellers to at a deep discount price, right? It's making people get in and sell at a deeply discounted price, okay? The open float below the old lows may also have sell stops for breakout systems that wish to sell on weakness. Remember when the breakout traders you got sell stops sitting down there for people that's already in longs, and you got sell stops sitting down there for people who want to get short on a breakout, right? So the open float, that's just, I'm gonna stop there real quick. I just want to point out, because I just noticed that I misspoke right there, but the sell stops are for people that are already long, right? Because a sell stop is a stop loss order, right? That's a market order that's getting people out that's already long. The people that want to get short on a breakout, there's going to be a stop limit order in there. There's going to be a sell limit in order in there, right? Because price is currently above you, and if you're below price, when you're trying to put in a sell order, you can put in a sell limit order to get you in when it comes down. But you can put in a stop market order if you're already in a position. But the sell limit order is, so you got limit orders resting down there waiting on people to get in and go short, and you got stop market orders in there waiting on people that's already long that say, if it get below this, then take me out the market. All right, those are the two different kind of orders that are waiting down there in that liquidity pool. Carry on. The liquidity pool with open orders sitting down there waiting to get in to go short on a breakout. This model is called offset accumulation. Its primary purpose is to offset current long holders and or induce more selling at discount prices. The model is seen frequently in bullish market conditions, and while higher time frame institutional order flow is suggesting higher prices, right? Typical offset accumulation models unfold quickly, and you must learn to anticipate them at key lows intraday. Reaccumulation. IPTA will reprice the market lower to a fair value price array to provide smart money discount prices for long entries. The market will be bullish from an institutional perspective and many times unfold after recent sell stop raids. The retracement lower in price will place pain on current long holders and tend to induce selling, thus providing sell side liquidity to pair smart money long entries with. This model is called reaccumulation. Its primary purpose is to reaccumulate new long entries and or induce more selling at discount prices. The model is seen frequently in bullish market conditions, and while higher time frame institutional order flow is suggesting higher prices. Typically, reaccumulation models unfold quickly, and you must learn to anticipate them at key discount arrays intraday. Whoo, that's a whole lot of reading, a whole lot of saying, a whole lot of words. Now, what does that really mean in its simplest terms? What simplest form? Offset accumulation. Nothing more than a stop sweep, liquidity sweep, stop run, whatever you call it. It's just when the market sweep stops. Judas swing, turtle soup, Le Judas. That's all offset accumulation is. Reaccumulation, just a retracement back to fair value, like coming back to a fair value gap. That's all it is in simplest terms, right? Where can you anticipate seeing offset accumulation? At an anticipatory reactionary point, or when price comes to, how price comes to equilibrium, it's in like 50% of the range, and it'll tend to start consolidating. If price is still bullish, it will sweep the lows again before continuing up. That's a key factor in knowing if you're still in the buy program. Why? Because the PD arrays below price, like a swing lows and bullish fair value gaps, these PD arrays that are below price, not just below in a discount, but below price as far as discount, they will support price. They will support bullish price. So swing lows, if they get swept, it'll be a quick sweep and reject off quick. Fair value gaps, it'll be a quick dip and reject off quick. Down close candles, it'll be a quick touch and take off quick. Any down close candle, bullish fair value gap, and swing low in a buy program will support price. And when they start to fail to support price, that's when you may have a clue that the buy program is over. And you may be getting ready to go into a sell program. Now, the key difference between the sell program and the buy program is the name. In the buy program, you got offset accumulation and reaccumulation. In the sell program, you got offset distribution and redistribution. Everything else is pretty much the same, except for you're running highs instead of running lows, and you're retracing back to bearish fair value gaps instead of bullish fair value gaps. You're retracing to premium arrays instead of retracing to discount arrays. Okay? Now, in a sell program, IPTA will perform one of two price engine models. Accumulate buy-side liquidity by repricing above an old high. Buy stops will be triggered, inducing counterparty buyers to pair short entries with. Price will seek a lower short-term discount array to offset positions. Reaccumulate fair value in retracements higher at premium arrays. See, you're going to the premium instead of to the discount. You're going to highs instead of lows. You're going to bearish PD arrays instead of bullish PD arrays. Just flipping it over on his head. Offset distribution. IPTA will reprice the market above an old high to promote buy stops that will be residing there for current short holders. This in essence engineers buyers at premium prices. The open float above the old high may also have buy stops for breakout systems that wish to buy on strength. You see how it's the mirror of offset accumulation? Just the opposite. Strength, weakness, premium, discount. Just the opposite end. The model is called offset distribution. Remember, that's the key. In the sell program, it's offset distribution, and the buy program is offset accumulation. And the sell program is redistribution, and the buy program is reaccumulation, right? Its primary purpose is to offset current short holders and or induce more buyers at premium prices, force them to pay more than they really want to pay. The model is seen frequently in bearish market conditions, and while higher time frame institutional order flow suggests lower prices. So you're anticipating the market to drop, so you want to see it manipulated up and then continue. I want to pause it right there. Don't want to just gloss over what's being said right here, right? Just like in the bullish, okay? The model is seen frequently in bearish market conditions, while the higher time frame institutional order flow is suggesting lower prices, right? You always want to understand what's the draw. Are we in a buy program or are we in a sell program? Okay. And if we're in a higher time frame buy program, it's a good idea to be looking for reasons to buy. If it's not offering you an opportunity to buy that day, sometimes it's best just to sit on your hands. If we're in a higher time frame sell program, it's better to be looking for reasons to sell. If it's not offering opportunities to sell that day, sometimes it's better to sit on your hands. A lot of times we try to trade in both directions, we end up doing more harm than good. So I just really want you to understand, when it comes to order flow and price delivery, this is the cream de la cream of it all. This is what you want to understand. This is the sine qua non of it, right? Without this, it ain't nothing else, right? You want to understand, are we in a buy program, sell program? If we're in a buy program, I'm going to be disciplined enough to only be looking for reasons to buy, because that way I'm going to only be taking high probability trades. Okay, and reverse for the sale program. All right, down. And redistribution, again, is just like reaccumulation, except for you're moving to the premium and you're attacking highs instead of moving to a discount and attacking lows. Right now, let's see what it looks like. Simple terms. Just like in the offset accumulation, the offset distribution is just a stop sweep, a stop run, a stop raid, whatever you want to call it. When price sweeps highs and then displaces lower. Okay? And redistribution, it returns to fair value. You go back to a bearish fair value gap. You move back up to a bearish order block. When you return back up to an area of fair value and then continue down. And just like in a buy program, as long as you see premium PD arrays, meaning PD arrays above price, not only in a premium, but PD arrays above price, resisting the price action, then you know the sale program is intact. Swing highs, if they get touched, they reject quickly. Bearish fair value gaps, when they get touched, they get respected and push price down. Up close candles, if you trade back into them, they resist price. So swing highs, bearish fair value gaps, up close candles, you want to see them all resisting price to know that the sale program is still intact. Now, that's just a quick introduction to the buy and sell programs. The buy programs. Oh, hopefully that wasn't echoing. I left my mic on. Hopefully it wasn't echoing toward the end. So, y'all got the homework from last time, from the last video. You know, go back through and do your homework. Buy program and sell program, it's pretty simple, but you know, the only thing I want to reiterate again is make sure you understand the high time frame. If it's bearish order flow, you're looking for reasons to sell in the premium. High time frame, if it's bullish order flow, you're looking for reasons to buy in a discount, right? Don't just jump out there and be like, oh, I see a bullish fair value gap, I'm gonna buy it, and that bullish fair value gap is being created in the premium, right? You're anticipating that to become an inversion fair value gap because it's a bullish PD array being created in the premium of the dealing range, right? You're not looking to buy off of that if it's bullish order flow and it's created in the premium. Same thing with bearish. You're not looking to sell off a bearish PD array that's created in a discount of the dealing range. Understand the higher time frame order flow and don't just look for the patterns, right? Don't just look for patterns. Any questions from the gang? Tomorrow morning, we're going to have our first tape reading session. And then tomorrow evening, we're going to do the market maker model. I'm very tempted to do two different streams tomorrow. Do one stream to do the 3 videos for the market maker model. You know, take a little break for about an hour or so, and then come back and do the power of 3 stream so that we can finish the series and then just finish the rest of the week with tape reading. I think that's what I might do. Yeah. I think we might start, you know, a little earlier in the evening tomorrow night to do 3 videos on the market maker model. And then once we finish that, take a break for about an hour or so and then come back and do the last video on the power of 3. And then that'll wrap up the series, and we can just finish out the rest of the week with tape reading. Yeah, I think I just made up my mind on doing that. All right. Tomorrow morning, tape reading right here on the YouTube channel. Gang, y'all will be inside the Zoom. I'll send out the link inside the Zoom, and then I'll let everybody know what time we gonna do the first stream tomorrow evening. Yeah. Probably it's either gonna probably be around 6, maybe around 6, so we can look at all 3 and then take a break for about an hour, and then come back and look at the last one, and it won't be too late. Yeah. So I'll see everybody tomorrow at 9 here on the channel here. Gang. I'll send out the link in the Discord. Yeah, man, that's it. Appreciate y'all for hanging out with me, man. Y'all do me a favor, hit a like for the algorithm if you're not subscribed to the channel. You know what to do. Hit subscribe. Y'all give it up for yourself for tuning in. Get on Argo's internet and share my thoughts on this thing that we call price action. It's your boy, Timothy Rogers Sr., aka Aranya Grande. That should be a big spot if you know hablo español. Y'all be safe out here in these trading streets, man. Gone.